Today, folks, we're going to talk about the Canadian dividend stocks that are propelling the Canadian markets to all-time highs, actually outpacing the SP 500, which is quite perplexing considering just an odd couple months ago we went into an extreme fear market, a tariff war that was supposed to cripple the Canadian economy and potentially make us the 51st state, which clearly didn't come into fruition. And now we are here in a brand new paradigm, and the Canadian market is getting a lot of recognition. And I want to break down why, because dividend stocks you probably haven't considered. So if you're on a path to financial independence, if you damn well one day want to retire early, consider hitting that subscribe button. And before we talk about any of this, I just want to talk about some plays that I haven't brought up in a while, more related to the US, especially when it comes to interest rates in money market funds. I had a prediction that as they cut interest rates, the heavily affected higher interest rate sensitive stocks, your infrastructure plays, energy, a lot of stocks out there would start to recover. And we've seen that in the Canadian economy. And one of the reasons probably propelling our markets is the lower rates. The US, however, has been holding on to higher rates, which has led to record levels of money in money market funds, cash sitting in fixed investments at $7.2 trillion. There's still an expectation as they start to cut rates in the US, which has been very long and drawn out, that some of this money is going to look for new places to collect cash flow. And it's likely they might run into the heavier hit dividend sector, which we kind of see in things like SCHD as an example, but it'll be neat to see if that play still works out over time. And we're also seeing margin accounts probably start to level off and bottom out here. We only have data going back to March of basically the 25th of March. We don't have the April data, which is likely the last bottoming cycle. I imagine right now people are going right back into margin, but we did see quite a pullback in margin, which does affect the markets materially. And I can tell you that we're in a bottoming because look at the US dollar. The tariff war kind of coming to an end, Trump alleviating a lot of the extreme tariffs and all the insanity that was initially going on. And we're getting a bump in the US dollar right now. And if you take a look at the year to date, it was quite a cyclical down period ever since Trump took office, but that might start to get alleviated as extreme pressures start to kind of pull back. So this isn't good for the Canadian dollar overall, but we saw a lot of people take money out of USD and it did bolster a lot of global currencies, but still, the US is proving to be quite dominant, especially if you zoom out, over the all chart here and you take a look that we're still sitting at levels not really seen since the early 2000 era. So very interesting nonetheless. But if we zoom in on equities themselves and we just take a look at my two favorite ETFs versus the S&P 500, being VDY, my Canadian monthly paying dividend ETF, and VCE, which is the comparable of VOO, the S&P 500 ETF, but in Canada. And we can see that VCE specifically, represented by the blue line, is heavily outpacing by 5-6% over VOO, the S&P 500. And you got to keep in mind, we pay way higher dividends in Canada than the US. So this doesn't include the dividend returns, but VCE pays like 3%. VDY was 4% and a lot more if you bought up some of these dips. But why have we been more smooth and on a higher accelerated rate than the US markets have in this recovery? And I'm going to tell you, it's not what you think it is. It is a really interesting market that I don't pay much attention to called gold, baby. Gold, silver, commodities. Canada is a commodity-rich country. It's one of the reasons Trump probably wants to take over our country. We're like one of the top 3 oil reserved countries. We have huge uranium deposits. We have massive gold and silver output. And with gold in 2024 going into a brand new bull market, hitting over 3,000 US an ounce, it is no surprise that when you look at the broader Canadian markets, the non-energy minerals have been in double-digit return places right now, which I wish I was smart enough to just say, hey, gold's up a lot, it's continuing to rally, why not just buy some of the gold producers? They're going to lag the gold price and performance because they're going to post on earnings. When those earnings get posted, it's likely you're going to get massive bumps, which if we take one of the better performers, being this kind of little stock, I wouldn't say it's little, it's like a $20 billion company, but Kinross Gold, since 2024, look at that rally, 135%, baby. These gold companies are going back into record highs, and it's not because of production. I mean, if you just take a look, first and foremost, produced ounces from this company on their recent Q1 filings. I mean, they're producing not that many more ounces. I mean, year over year, there's barely been any change, only by a couple thousand ounces. But when you look at the metal sales, almost 1.5 billion versus 1 billion this time last year. Oh man, we ain't talking small numbers anymore here, folks. These are massive, massive numbers that didn't result from any further production. And you look at the earnings at 30 cents versus 10 cents. So I don't buy gold. Do you guys pay a lot of attention to the gold markets? I'd love to know what you think about this, because I feel like gold is one of those manipulated prices that are probably going up because many economies, countries, major banks, governments are bolstering their gold positions in their banks. I can't imagine me and you are causing this rally. Like, it's got to be some massive institutional buying and government buying, but I feel like that could also come to an end at some point. So I don't know. I'm not chasing it here by any metric, but when you compare it to every other sector in the market, especially when we look at the mega companies, unlike, the US that has Apple and Microsoft, we more or less have banks as our major companies. Royal Bank, TD making up the two largest positions in the Canadian economy, and TD is up almost 17% year to date, largely driven by the underperformance that was driven by the money laundering schemes and all the stuff that went on that they have to pay fines for. They're asset locked right now in the United States. They can still grow in Canada, and they are still trading at quite a hefty premium. Most of the banks are right now, so it'll be neat to see when earnings come out in the next 1 to 2 weeks with all the banks, if they can actually start to rebound in performance. Because if you take a look, TD, and I told you guys, when these banks dip heavily, they're always buying opportunities, and you can kind of base it off the dividend yield. TD was paying at a yield of over 5%. I think it was getting close to 6% at one point, and we haven't seen a yield this high on TD virtually since 2008 financial crisis or the mid to early 2000s. So this is a rare opportunity if you believe in them, but like Pokemon cards, I just want to collect them all. TD is upper weighted in VDY, same with Royal Bank, and I'm perfectly fine with that. Exposure, it's the easiest way to just pick one ETF and get exposure to all of them instead of buying them in a sector-focused ETF or, individually. But nonetheless, when you take a look at revenues here, they're still up year over year, which was great to see. And something tells me the performance is going to be fine, and it'll largely be driven by provisions for credit losses, which continue to go up, which is quite concerning. But now that we're in a lower interest rate environment, if we get a leveling off in loan losses or even finally start going to the downside, that could really bolster the bank earnings and take us into a new paradigm shift into a return, because that's been my bet on the banks. As soon as things level off, as soon as loan losses start coming down, earnings should start to bolster, and there could still be some major potential upside in the future. So over the next 1 to 2 weeks, pay attention to the banking sector. But I want to talk about TMX Group, another financial institution, very representative of the Intercontinental Exchange, which you've never heard of it, basically represents the New York Stock Exchange. These are the companies that actually list and bring public what you're able to buy in your brokerage account. And this is the TMX Group that represents the Toronto Stock Exchange, and it is up 23% this year. The Canadian markets have been, I think, in a new shift of focus when it comes to listing, because, man, since 2024, I don't know what happened, but this thing rallied almost 100% and has been one of the best performing Canadian stocks, yielding about 1.46% to date. I mean, it's not a huge dividend yield by any metric, but the growth here has been nothing short of astonishing. Double digit, representative of what could be considered major tech companies in the US, to get this kind of growth and still quite incredible overall margins. I mean, you're talking about a company that went from $345 million to $419 million. 21% growth is nothing short of incredible, and 24% earnings per share growth. This company is a rocket ship, actually trading at quite a favorable value of a 34 PE, which still is why I think Google and Meta could be considered undervalued plays, because if this thing could trade at a 34 PE at that kind of growth, there's very considerable similar growth in things like Meta in the US. But still, nonetheless, TMX, whoo, baby. I don't pay too much attention to this industry, but it's one that you probably should be, but has been one bolstering the broader Canadian markets as well. And I just want to point out one consumer discretionary company here, Dollarama. This has been another major outlier. And what's been incredible is on the back of the tariff war, Dollar Tree and more of the US-focused, dollar store stocks tanked miserably. Yet this one's at all-time highs, up 20%. Face-ripping rallies, one of the best performing 5-year Canadian stocks. The yield, I know, is not attractive anymore, but man, this company, I remember looking at it in 2018. I wish I bought it and held on to it, because my God, the returns here have been disgusting. I mean, look at the sales increases year over year from 1.63 billion to 1.88. Again, we're talking like double-digit growth rates, 140 versus 115 year over year. I don't know how a company like the Dollarama, really took over, considering, nothing at the dollar store costs $1 anymore. But I will say, if we go to the movie theater, we load up our pockets with snacks from the Dollarama before we'll go into the movie theater. So I'm like god awfully impressed with this company, especially when you look at their gross profit. I mean, the margins they're able to squeeze out of it really shows you that, they're ordering products from overseas, obviously, and would have been largely affected by tariffs, but have been gliding through this quite nicely. So I'm going to applaud the Dollarama. What an intriguing and interesting company to be paying attention to. And finally, the last stock, the honorable mention that I've already talked about, has to be TELUS up 12%, not double digits, but one that I think will continue to see a recovery here with a 7.5% yield. It is already starting to see the interest rate cuts take effect on its bottom line, and I think the entire telecom space has finally found its bottom. And this is a huge, considerable company at $30 billion in value. What's TMX? I mean, the Dollarama's $46 billion, TSX $15 billion. All these companies, with the exception of TD, are all kind of trading at similar mid-cap range sizes. But when you take a look at the overall TSX, it's mostly a handful of mega caps, which we could talk about with Enbridge, Royal Bank, TD, but most mid caps actually do make up the vast majority of the performance that we're seeing this year. So I find these companies fascinating, and I love that you can just buy ETFs and get rankings in almost all of them. And I would say that Canada you want to buy for dividend income over growth, or growth-oriented stocks, because you look at Constellation Software or even Shopify, and they have not been material performers this year, incomparable to some of the stocks that we're looking at. Now, finally, the U.S. is heading into what I'm going to consider a very interesting period of share buybacks, and this is something you should pay attention to because I almost prefer this over dividends for the most part. And you see with companies like Google doing 4% share buybacks, 0.5% dividend, you're getting a 4.5% rate of return annually just from them reinvesting that $150 billion. Like, they have so much cash. All the top mega US tech companies have crazy cash levels, and people have been pointing this as a good and a bad thing because still, buybacks can often send mixed signals to investors. While leadership is willingness to invest money in their own shares can be seen as a sign of confidence, it can also suggest that they're holding off on capital investments due to lack of certainty about the future, which I think is complete and utter BS. I mean, these companies are investing hundreds of billions over the next 5 to 10 years in data centers. You look at the lineup of new tech coming out of companies like Tesla and Google and Meta. They're all working on these forefronted technologies while still having the cash levels to bolster their bottom line and do share buybacks. Come on, guys. You don't get caught up in the fear and greed that we see in the markets. I mean, it's kind of ridiculous how people were losing their minds over this tariff war. And when I was telling you to buy and go aggressive, a lot of people were scared to do so. And now we're back into a whole new paradigm of growth that, many of us are taking advantage of right now. We're seeing the advantage of from buying through this period. And it never lasts as long as we'd hope. But I'd love to know what you think about this. What are your favorite Canadian dividend stocks? And so much more in that comment section below.